Hi everyone and welcome to this new video. This time we will be talking about monthly dividend stocks. As you know, most stocks will pay dividends on an annual, semi-annual, or quarterly basis. But certain stocks, especially Reits and also some other stocks, will pay dividends on a monthly basis. It's absolutely great if you're looking to build a passive income, and on a monthly basis it's also convenient since it matches with your bills which come on a monthly basis too. So monthly dividend stocks are there is a bunch in on the Toronto Stock Exchange, but I limited myself to stocks that are dividend aristocrats. If you're not yet familiar with this concept, the dividend aristocrats is an index set up by Standard and Poor's. So there's people working at Standard and Poor's, and they came up with this index. And to be member of the this club of dividend aristocrats, you have to have paid dividend every year for at least 5 years. So you have to pay dividends every year and increase them every year. If you do this within 5 years, and there is a certain liquidity requirement, so it has to be a liquid stock, not any small company, or so it has to be a certain volume on the Toronto Stock Exchange to be considered a dividend aristocrats. So once you meet that criteria, you're part of the index. The Canadian index, the criteria is really good. The only drawback I find is that they establish only a minimum of 5 years of successive dividend increases. The US version of the dividend aristocrats, their minimum is at 25 years. So the index is really high quality stocks that are in there. The Canadian one, the minimum is 5 years. I find it's too low. It should be at least 10 years, but it's a good starting point as a list. It's a good starting point, and there is stocks in there that have been paying dividends for over 20 years, like Enbridge and such. So it's a good starting point, and I used the dividend aristocrats list to select the best monthly dividend stocks. Before we go on to explain what a dividend aristocrats and why it's a good idea to focus only on those if you're trying to build long-term or you're seeking also income and growth, it's a good option. But before that, just I want to raise a certain point is that don't focus only on the characteristic of a monthly dividend because you're going to limit yourself only to a few stocks, and you will see the list is dominated by REITs. So it should not be your major criteria. Try to invest in dividend stocks that pay on a quarterly, semi-annual, or annual, and try to build a calendar so you know the revenues well when they will be coming in. So it's better because you will have more choice and you could select like the best stocks available instead of just limiting yourself to monthly stocks, monthly dividend stocks, because then you will be stuck with a portfolio dominated by REITs. So this is just as a little warning. So the dividend aristocrats, why I like the idea here is that they tend to dominate their industry. To be able to pay dividends every year and increase them is a lot of work, and you have to dominate your industry. You have to be quite comfortable in your industry. You have to generate enough cash flow to be able to do that. It's not every company can basically brag about, or it's not easy to accomplish even on the operational side of the business to maintain this certain discipline, so you'll be able to pay your dividends on an annual basis and increase them. So it's quite important to keep that in mind. You're investing in quality stocks, especially when the company has been paid dividends for over 10 years, 15 years. Usually they are blue chip stocks. It's safe haven during turbulent times. Why? Because when the markets start to be volatile like it's right now, investors will move from high growth, high risk stocks to uh, like most established big names companies, and usually those are dividend payers stocks. So dividend aristocrats are less volatile than the market usually because they are safer. They are a safe bet. They are a company that's well established, so they are safer than, let's say, investing in a small cap or a mid cap growth stock. They have strong financial statements. It goes with the ability to pay and raise cash flows on a regular and every year. So you definitely have a strong balance sheet, lower debt than other stocks. So that's also another characteristic of dividend aristocrats. A lot of people criticize the dividend aristocrats as stocks that offer limited growth. I disagree with that. I mean, there is a limited growth because if it's a business that's in a defensive industry, there's nothing like you can innovate in the defensive industry much. You cannot innovate much. However, dividend stocks are there are two kinds of dividend stocks. There is dividend stocks that pay a high dividend yield and they are stable over time and they are well established. They are in an industry that's, for example, defensive industry like Coca-Cola or things like that. So that you won't expect a huge growth, but your dividends is safe and is quite high because the company is able to generate enough cash flow. So this is type number one. And the second type is dividend stocks that have low yield, that offer a low yield. However, these stocks, they offer low yield because they are still investing in their growth. So you have to build an income portfolio that will comprise these two categories. So you will have dividends and growth together. So it's just a strategy when you're investing in dividend stocks to keep this in mind. Don't just chase the high yield. Go for some high yields and also for low yield but growth potential. How to select a monthly dividend stocks. Whenever we speak about dividends and the ability of the business to pay dividends, you have to look at the payout ratio. The payout ratio is simply how much of your earnings goes to pay dividends. So if it's 40% and your earning is $100, you're paying 40% of your earning or of your profit as dividend. 40% is a good rate because you still have 60% that you can invest in growth. If the payout ratio starts to be higher than 75, 80, more than 100%, then it's a warning there. You have to dig deep. You have to dig deeper to understand why it's such a high payout ratio. It becomes a question of sustainability. The company cannot pay 100% of its earning each year and without consequences. So there will be consequences. So there will be limited growth, that's for sure, or no growth because they are not investing they are not keeping any funds. They are just paying everything that they make as a profit. So you have to pay close attention to the payout ratio. It's available on, if you check on Yahoo Finance or Google or barchart.com, you will have the access to that information. And websites like MarketBeat even provide the payout ratio to cash, which is also very, very pertinent ratio because now your dividends on the cash flow generated by the company. So it gives you, like, if it's more than 100%, it's definitely a company that you should avoid. A company that pays more than the cash flow that it's generating is definitely a no-no. So they are basically borrowing to pay your dividends. So you have to pay close attention to the payout ratio to cash. You have to focus also on total return. This is a common mistake with dividend investors. They go for the yield and they forgot about the performance. I mean, you could have a good yield, but if your price performance sucks, well, basically you're not making money because you will be making 5% or let's say 10% dividend yield, but the stocks keeps falling and the price performance is not there. You're at minus 15%. So it doesn't make sense. You have to focus on total return, invest on companies that are profitable, that the market has confidence in them and they have good performance. Do not invest in a company with lousy performance and high yield because you're just shooting yourself in the foot. Now for the list, the monthly dividend stocks Canada for the dividend aristocrats, I included two pieces of information, the dividend yield, obviously, and also the dividend streak, which is the number of years that the company increased its dividend. So you have here the list of the businesses. It's dominated by REITs, as I told you earlier. So you have Granite REIT, Exchange Income Fund. And you have also some energy companies, especially gas, like Pembina Pipeline. And also you have some companies here like Savaria Corporation. I like this one. It's a company um, based in Quebec, which has potential for growth and at the same time pays a decent yield of 3.26%. So the full list is here. They were ranked by the dividend streak, the number of years that they have increased their dividends. Obviously, you have to do more research to select the one that will better fit your portfolio. I included also in my blog the 5 years dividend growth, which is quite important to look at because with inflation hammering our savings, so the dividends needs to at least grow in at a rate that protects you against inflation. So try to avoid companies that want to stay on the list and increase dividend just by just 0.5% every year just to stay in the list. Try to check companies that like Savaria, for example, has over the past 5 years has increased its dividends by 17%. So you should be targeting companies that have a high growth percent rate in their dividends, because that will tell you you'll be getting yield, good dividend yield, and also it will be increasing higher or at least at the same rate as inflation. So I hope this video helped you, and if you have any questions, please don't hesitate. And I will post the link to the article that's in my blog, wiseinvestors.com, and have a great day. Thank you.